So the home you bought didn't appraise. Now what? Unfortunately, because of market dynamics, we are seeing a little bit more of this. So I want to walk through different options that you can use if the home that you're buying doesn't appraise. A big reason why we're seeing this happen right now is simply to get a home under contract. Buyers are having to go over list price just to get the home that they want. Now, that does not automatically mean that the home isn't going to appraise, but it does mean that it can make it more difficult. The reason being, when you're getting a mortgage, an appraisal most often has to be done, and the appraiser has to work with standard guidelines for how comps or comparable sales can be chosen to establish the value. There are criteria like needing to make sure that the sales have occurred within the last 6 months, ideally that it's homes around a 1 mile radius from the home that you're buying, and also that the homes being used are similar, meaning it's a 2-story home compared to maybe a ranch or other things like that. So there's a lot of variability that does go into an appraisal. And sometimes, to be honest, the appraisal may not be a good appraisal, meaning there is an amount of subjectivity in what value is used. And that's based off of market knowledge and also comparing property to property and picking certain ones to be used to establish that value. I'm Rebecca, the Mortgage Mentor. I am here to make mortgages make sense and show you how to buy a home in the smart way. So make sure that you subscribe and chime in with any questions that you have. If a home that you're buying doesn't appraise, the first option that you have is to simply cancel the contract. If you feel that the home is not worth what you are under contract for based off of that appraisal, the next conversation you need to have is with your realtor to see what your options are to get out of the contract. Keep in mind that that typically does not come with some sort of cost. You might lose your earnest money or other fees associated with the contract, to include having already paid the appraisal fee. But there are options available, and you just need to understand what suits you best. Let's say that you decide to stay in the contract, either because the cost to get out of the contract is too high, or you feel like in spite of the appraised value, you still want the home and you still feel like that the price that is on the contract is worth it. The first thing that you can do with most loan types is called a reconsideration of value. And what that is an appeal back to the appraiser, asking them to make corrections for errors that are in the report, or to potentially consider other sales, other comps, other comparable sales, instead of the ones that were used in the report. Keep in mind that there's criteria for what kind of information can be submitted. You can't necessarily go in and nitpick and say, why did you give this value for a pool, or why did you give this value for a fence? But you can present evidence to the contrary of the numbers that they used, particularly if there are other sales that seem more appropriate. Sales that may not be used would be homes that are either sold for sale by owner or if they were bought by a corporation. Typically, those may not be used because they were not considered exposed to the market. All of that is put together in an appeal on a standard form back to the appraiser, and then the appraiser will respond. Either why those comps were not chosen, or if you are able to demonstrate that there's better information to be used, then that can increase the appraised value. If that doesn't work, you can ask the seller to lower the sales price. Depending on your market, the seller may or may not be willing to do that, because they may know that they can very easily put the home back on the market and it will sell for that. Keeping in mind that all of this comes down to negotiations. They might lower the price of the home a little bit. They might split the difference. If there were any kind of seller concessions or seller paid closing costs, they may take those away in lieu of a lower sales price, making sure that their bottom line stays for what they want it to be. Now, all of that considered, why would somebody overpay for a home? Why would they continue to purchase a home if it has underappraised? A lot of times it's because it's the best option that's out there. Perhaps the alternative of renting or re-entering the market and finding another home isn't feasible based off of somebody's timelines or preferences or just their personal tolerance to deal with this housing market. The first thing that a buyer can do is pay the difference. Because keeping in mind that the biggest thing that an appraisal comes into for the mortgage is establishing the loan to value. The loan to value is the loan amount compared to the sales price or the appraised value, whichever is lower. So if your sales price, for example, is at $500,000 and your loan amount is at $400,000, if it appraises for $500,000, your loan to value is 80%, meaning you have met the 20% threshold to not need mortgage insurance and everything can proceed. However, if you're buying it at $500,000 and let's say that it appraises at $475,000, your loan to value is now at 84%. At that point, you have two options. You can either pay the difference or you can opt for mortgage insurance. So what that means as far as paying the difference is if it appraises at $475,000 and you want an 80% loan to value so you don't have to have mortgage insurance, then that means that the new loan amount would have to be $380,000 instead of the original $400,000. Because if the seller's not dropping the sales price, if the appraiser is not raising the value, we're working with that $475,000 appraised value, but a $500,000 sales price and a maximum loan amount of $380,000, that means that your $100,000 down payment has now turned into $120,000. Just because you can pay that difference doesn't mean that you might want to. So then we're switching over into option 2, which means we're keeping the sales price the same, we're working with the $475,000 appraisal, and we want to keep our down payment and the loan amount the same with $100,000 down payment and $400,000 loan amount, and now mortgage insurance is in play. There are two ways that you can pay the mortgage insurance. You can either pay it monthly, which is the way that most people are familiar with, and that's something that can be a good option knowing that in the future that mortgage insurance can be removed. So your payment will go up slightly to accommodate for that monthly mortgage insurance, but you're not having to come out of pocket for more down payment. The second option for mortgage insurance is you can pay it as a one-time charge. It can either be paid as additional closing cost, you may be able to roll it into the loan amount, finance it back into the loan amount, or you can opt for a slightly higher interest rate, which gives the lender a credit. The lender takes that credit and pays the mortgage insurance premium. All three of those can be options, and all three of those should be looked at to determine which option best fits your long-term plans and which one gives you the most flexibility for your preferences. It can be very unsettling when your home doesn't appraise because you've already worked so hard to just get it under contract in the first place. Let me give you some words of comfort that the majority of the time, a solution can be reached. It might not be your original plan, but it is an acceptable solution to move forward with buying your home. I'm Rebecca, the Mortgage Mentor. I'm here to teach you everything I know about mortgages so you feel confident in making smart home buying decisions. Be sure to subscribe, comment with any questions that you have, and if you want to reach out to me individually, please do so. I'm here to help.